What's up, YouTube? Corey Hankerson here from Legacy Tax and Financial Planning, coming to you live from the Washington Auto Show, standing in front of this fantastic new Range Rover. Listen, if you're thinking about buying a new car or truck, don't you dare buy one until you watch this video. I'm going to explain how you can write off 100% of the car's purchase price in the very first year. Let's dive right in. Okay, guys, before we get into the content, if you haven't already done so, I want to remind you to please subscribe to our channel and hit that notification bell so you'll be notified each time we post a new video. And finally, follow us on Instagram as well as Facebook. We post new content there as well. All right, so everybody needs transportation. And sooner or later, most of us are going to go out and purchase a vehicle to get around in, right? But if you're a business owner, even if it's a small home-based business, you may be able to write off some or all of that vehicle's purchase price under Section 179 of the Internal Revenue Code. What is the 179 deduction? So most people think of Section 179 as some mysterious, complicated section of the tax code. It isn't really all that complicated, though. See, essentially, Section 179 of the IRS Code allows a business to deduct the full purchase price of qualifying equipment or software, whether you financed it or bought it outright, during the same year of the purchase, instead of depreciating it over a long period of time. So that means that if you buy or lease a piece of equipment, you can deduct the full purchase price from your gross income and thereby lower your taxes, right? That it's an incentive that was created by the government to encourage businesses to buy equipment and invest in themselves. In the past, when your business bought qualifying equipment, it typically had to write it off a little at a time through depreciation. So for example, let's say you went out and bought a $50,000 piece of machinery. You would get to write off, let's say, $10,000 a year for 5 years. These numbers are just meant for example purposes, right? Now, while it's true that this is better than no write-off at all, most business owners, I want to say all business owners, would really prefer to write off the entire equipment purchase price in the year that they bought it, rather than take a write-off slowly over time. But that's exactly what Section 179 does. It allows your business to write off the entire purchase price for qualifying equipment in the current year, subject to certain limitations, because there's always going to be limitations and caveats and all those kind of things. So what type of property qualifies for Section 179? We're talking about buildings, we're talking about machinery, we're talking about vehicles, furniture, equipment, software, patents, copyright, livestock, and even, drumroll, vehicles. Now, several years ago, Section 179 was often referred to as the SUV tax loophole or the Hummer tax, the Hummer deduction. And that's because many business owners use this section of the tax code to really write off the purchase of big, expensive SUVs like Hummers or Escalades. However, the IRS, they got wise to that and they really tightened up the rules a little bit. But Section 179 is still a powerful tool for business owners to go out and acquire equipment, specifically vehicles. But exactly what type of vehicles qualify and how much can you deduct? So for passenger cars, you can deduct up to $11,160 in the year that the vehicle is purchased and placed into service. For SUVs and trucks that have a gross vehicle weight over 6,000 pounds, but less than 14,000 pounds, you can qualify to be able to deduct up to $25,000 if the vehicle is purchased and put into place prior to the end of the year. There are other limitations and conditions that apply. But as you can see, the largest deductions are for big trucks and SUVs. We're talking about vehicles like the Ford F-150, the Chevy Tahoe, the Dodge Ram, Range Rover, GMC Yukon, Mercedes GLS. You get the picture. Now, I can hear you saying, you said you were going to show us how to write off 100% of the vehicle's purchase price. You can't purchase a whole truck for $25,000. Was that just clickbait? Not really. See, there are some exceptions to the $25,000 limit and some strategies that allow you to write off the entire purchase price. Here are 3 ways to go about getting that done. First, there are types of vehicles that are exempt from the $25,000 limit entirely. In fact, they're exempt from any limit entirely. We're talking about shuttle vans that seat more than 9 passengers behind the driver. Pickup trucks with full-size cargo beds. The bed has to be at least 6 feet long and not accessible to the driver from inside the vehicle, like the one you see here. We're talking about delivery vehicles like this one, with no seating whatsoever behind the driver. These types of vehicles don't have a limit. They're not subject to that $25,000 limit on the amount that you can deduct. You can deduct the entire purchase price in the year that you buy the vehicle and place it into service, even if that purchase price is more than $25,000. Here's the second strategy. Now, nothing says you have to buy a brand new vehicle. So you might not be able to find a new Tahoe or a new F-150 for less than $25,000. But you certainly can find one just a few years old that fits the bill. IRS Publication 946 specifically states that the property can be either new or, quote, new to you, which means that you can take the deduction for purchasing a previously owned vehicle. Now, a quick search on autotrader.com today, which is February 2nd, 2020, shows that there are used Ford F-150s and used Chevy Tahoes selling for less than $25,000 within 100,000 miles of my house here in Maryland. There are literally hundreds of them, of used vehicles. We're talking about Tahoes, we're talking about F-150s. I see a couple of Yukons here. There are a couple of Mercedes vehicles here I see. So there are all sorts of vehicles that are within the criteria, over 6,000 pounds, less than 14,000 pounds, that you can buy a used one for less than $25,000. So you consider buying one of these, and the Section 179 deductions would completely cover the purchase price. The third strategy, you don't have to buy the vehicle outright, right? IRS Publication 946 tells us that even a vehicle that is subject to debt qualifies as a vehicle which you own for purposes of Section 179. Here's what that means. That means that according to the IRS, they consider you to be the owner. This is a vehicle you own, even if you bought it with a loan and you're still making payments. So what's the play? You go out and you purchase a newer vehicle with financing and use that $25,000 deduction to offset the monthly auto loan payment. So let's say you go out and buy a newer GMC Yukon, a brand new GMC Yukon for $60,000 with a monthly payment of $925. The Section 179 deduction will cover the monthly auto loan payment for 24 months. After 24 months, maybe you consider trading in the Yukon and getting another new one and claiming the deduction all over again. That way you have this deduction that's essentially making your monthly payments for you. So you didn't think of that one. Now, we've discussed let me take a step back. If you like that strategy, the first one, second one, and third one, I want you to go ahead and hit the like button down below. If you haven't subscribed, go ahead and subscribe to the channel here. Shameless plug. I know, but show us some love, show us some support, right? So we've discussed the pros, but what about the cons? Are there any potential pitfalls with 179? 3, kind of 4. The vehicle must be used for business purposes. That means that personal use is not deductible, okay? If you're using the vehicle half for personal and half for business, then you can only claim 50% of the deduction. You'll want to keep a log of your mileage to prove what percentage was personal and what percentage of the vehicle's use was business. You'll have a hard time proving that the vehicle was used 100% for business use if you don't also have another vehicle that you can use for personal use. So in other words, if the vehicle that you're claiming the 179 deduction on is the only vehicle that you own, you're probably going to have a hard time claiming that it was 100% business use. So you want to keep a log, and if you're going to try to claim 100% use, you want to have another vehicle on the side. The second thing has to do with your basis, right? So deducting 100% of the vehicle's purchase price is going to leave you with a zero basis in the vehicle, which means that when you go out and sell it, when your business sells the car, then you're going to have to pay capital gains tax on the proceeds of the sale. Okay, you want to talk to your tax pro about that one to make sure that you really understand it. There are some ways to get around it, but without some planning before you go out and sell the vehicle, you're going to be hit with the capital gains tax bill. So again, talk to a tax pro about that, or schedule an appointment to talk to us here at Legacy Tax. Number 3 is something called depreciation recapture. Essentially, that means if you ever stop using the vehicle for business use and decide you want it to now be a personal use vehicle, then you're going to have to pay back some of the money that you previously deducted under 179. Again, that's one for a tax pro. The last one here is you can't use Section 179 to generate a business loss, okay? In other words, you have to be making money and you have to have a tax liability of at least $25,000 in order to claim the full $25,000 deduction. So the bottom line is, if you're looking to buy a truck or an SUV, you want to talk to your tax advisor to see if the Section 179 deduction makes sense for you in your situation. Don't just throw money after deductions. If you don't really need something for your business, then don't go out and run out and buy it just to be able to claim the deduction. It's ultimately not a good idea. You want to make prudent and smart business decisions, not just chase after deductions. But if you actually need a new truck or a new SUV or a new piece of equipment for your business, then 179 is a powerful tool that can take your business to the next level. To learn more about the Section 179 deduction, I want you to visit IRS Publication 946. It talks all about how you depreciate property. Also, I want you to go ahead and look at Publication 463. It talks about travel and car expenses. I posted a link to both of those IRS publications in the description below. You click on them, it'll take you directly to irs.gov, where you can read or download those publications for yourself. Finally, if you like this video, you know what I'm going to say. I want you to go ahead and press the like button below and also subscribe to our channel. Don't forget to follow us on Facebook or Instagram. We do post content there as well. Finally, go to our website and schedule a free 30-minute tax strategy session. It's free, no obligation. Free means no cost, right? We can review your tax and financial situation to determine if Section 179 is a good tool for you and your business. There's a link to our scheduling website below in the description as well. All right, so that's it for now, guys. Talk to you later.